Ollie, it's great to have you back on InvestorStream. It has been a fairly busy quarter for the company following the divestiture of its non-US assets. Can you just run us through this and how the business has emerged post-transaction?
Yeah, thanks, Alex. Obviously great to be here, so thanks for having me. Big changes in last quarter. Company was tracking well, but we were carrying debt, and that was always a kind of burden to our share price being able to appreciate. The big transaction was selling the non-US territories to Prestige Brands. They're the current holder of the Australian license already. So we were able to sell those for $9.5 million US, and that's now allowed us to pay off all our debt. So we're now completely debt-free, but leaving us with kind of plenty of loose change, so to speak, to continue to run the business. So we've got a great, strong balance sheet compared to where we were, and now the core US business is really heading in the right direction.
Thanks, Ollie. Now, how has the divestiture of non-US assets affected the company's financial position and performance?
Yeah, look, it's definitely been a quarter of significant change. So the non-US business was sold for $9.5 million US, so a significant amount of money. That's allowed us to pay down all of our debt. And then during this transition period, we've had plenty of one-off expenses. If investors turn their eyes to the 4C, you'll see that there was $3 and a bit million paid out during the quarter, but 2.4 of those were one-off costs. There's been one-off marketing costs. There's been costs related to staff in terms of severance. There's admin and corporate costs between bankers and lawyers and all the people running and supporting the deal. And then, we've also paid off the debts, $5.5 million of debt. $1 million of that was interest. So you'll see that up the top of the 4C. So what it means is, while there was over $3 million of cash leaving, the $2.4 million of one-off costs means that net cash was closer to $700,000 for that quarter. And what's important is cash at bank at the end of this period. We've still got $3.2 million US dollars at cash at bank. So on that normalized $730,000 of cash allocated for operating activities during the period, it shows that we, at this rate, would still have well over 4 quarters worth of cash. But importantly, the plan is to continue to reduce expenditure. This is still a heavy quarter for us. We're still carrying the full burden of our complete team. We've started to wind down, and so operating expenses will continue to cut into this January quarter. And as sales continue to build, we got a combination of cutting costs and margin accretion, which means we continue to drive towards break even quicker and quicker. And that obviously extends our cash runway every month we improve.
And to finish, Ollie, the company seems to be in a fairly solid position moving into FY25. Alongside a focus on existing high-margin product sales, how does the company plan to increase its footprint in the US over the coming months?
Yeah, so with divestiture of Canada, we've been left with an Amazon-focused business in the US. In the last 12 months, as we've had a really rigorous focus on cost control and cash preservation, we actually deleted a lot of our kind of lower margin, lower returning SKUs. And so through that period, you've actually had to, at a gross level over the last couple of years, relatively flat sales. But underpinning that is significant growth in our new range. And our new range, led by our Hydration Plus Liver Detox SKU, is higher margin, it is a better return on marketing, and is at a higher repeat. So more consumers are coming back into the brand, having tried the product, they love it, they come back. And that's been a massive driver of our improved earnings position that continues to improve every month. And so as we kind of round the old period of all of our old SKUs being deleted, the new SKUs are starting to emerge as the real firepower behind the US business. So we're going to continue to focus on those. They're returning the best. We're going to be much more zeroed in on that range. And that allows us to be a leaner and meaner team, less people, less cash allocated to stock, and really drive in this new space that we call Hydration Plus.
Thanks, Ollie. Appreciate the update and all the best for 2025.
Thanks, Alex. Appreciate it.